Peace, family. Welcome to another episode of the Reinvented Masterclass channel, right? That's what we're going to call this. And if you're not sure, or if you've never heard of me, I'm Dub Washington, and I do two things. First and foremost, I make the banks compete to lend you money. And secondly, I ensure that everybody eat. And on today's masterclass, we're going to be going very in-depth, very high level, as I've seen a lot of fluff in the industry, and I read the comments, I read the feedback, and I see what you guys like. And I have my team taking note of any questions, any concerns, and then I am here to address any financial problems that you may have. My goal is to put you in position so you can propel and go to that next level to create financial freedom, whatever that looks like for you. So in today's masterclass, we're going to be talking about internal risk. We're going to be talking about business credit utilization. We're going to be talking about high risk NAICS code, not how you are used to hearing about them, but what if your NAICS code is tied to recent credit card defaults? Now your NAICS is high risk based on not what you did, but what other people in your industry have done. So once again, on this channel, we look at things from a different perspective. We look through a different lens, and we pretty much try to mitigate risks without the bank doing it for us. We are thinking as the banker or the underwriter, so we already know the questions and concerns that they're going to have, and we already beat them to the punch. So first and foremost, I want to start with just that. The industry standard per NAICS, right? And whenever I say NAICS, this is the NAICS code. This is where most people lose. What banks are really doing, banks don't compare you to everyone. Banks are generally comparing you to other businesses associated with your NAICS code. So they're asking, what is the normal revenue? What is the normal leverage? What is the normal exposure? What is the normal deposit behavior? Like all of the things that you don't realize you are being judged from, you're being calculated from, you're being predicted off of. These are things that's stopping you from getting max exposure in 2026. And that's what my goal is to do today, is to put you in position. It's not about having access to the information, because I meet a lot of people that watches my YouTube channel. They are a mentee. And just because you are close to information, that don't mean that you're going to execute on it. So my goal is to put you in position with leveraging these strategies. So if your numbers don't match your industry, guess what that is? That's a red flag. If the typical NAICS code is making 600,000 a year, it's making 700,000 a year, right? And you're not within the normal, I would say, revenue criteria of that particular NAICS code, you're then high risk based on the average of other businesses, or sole proprietorship, so on and so forth. Entrepreneurs, business owners, anybody that is struggling with access to maximum exposure with your personal credit cards, business credit cards, structuring your LLC or corporation. It's a multitude of things that you are missing out on, stopping you from getting access to your first $100,000 at 0%. And what I want to do is coach you to your first 100,000 or your first million. No matter where you're at, you're going to get value from my $99 community, where we break down everything from personal credit mastery, business credit mastery, travel hacking mastery, manufacturer spending mastery. Nothing is left off the table in this community. Listen, for only $99 a month, you can come and sit down with me and hundreds of other entrepreneurs and business owners and ask me rapid fire Q&A. How much would that be worth to sit down with a multi-seven-figure business owner to answer your questions? Most people say it's worth thousands, but I want to grant you access for only $99 a month, and you can cancel anytime with no pushback. I'll see you on the inside, and in my words, everybody eats. Let's go. Particular NAICS code, you're then high risk based on the average of other businesses, or sole proprietorship, so on and so forth, in your specific NAICS. So if your numbers don't match your industry, that is very much a red flag. A trucking company with $30,000 a month in revenue, very normal. A consulting firm with $30,000 a month revenue is low. A barbershop applying for $250,000, that's very aggressive. A logistics company applying for $250,000, that's reasonable. So the key insight is banks lend inside ranges. They want to put you in a certain range depending on your NAICS code. And oftentimes we have heard, hey, we go out, we set up a consulting business. And once we set up the consulting business, it's low risk and we can get access to maximum exposure. That's not always the truth. You have to understand the inner workings of how everything works in totality before you go and try to execute on certain information that is provided to you. So the next thing that I want to discuss is deposit velocity. This is the new credit score that nobody talks about. Deposit velocity is how money moves, not just how much. Banks track the frequency of deposits, the size consistency, the source diversity. Now, let me stop right here because a lot of people ask me this question. Whenever we're making these deposits, how are we making them? Is it through our W-2 job? Is it through a direct deposit? Is it through ACHs? Is it through cash deposits? Is it through money orders? How is it? I would tell you to leverage all. Because if you're running a true business, you're going to have customers pay you in a multitude of ways. Some is going to pay you with credit card payments. Some is going to want to pay you in cash via Cash App, Zelle, all other payment processors, right? Or all other payment opportunities. So you have to make sure that you are having a source diversity pertaining to the deposits. And we all know, I think it should go without saying, but I have to tell you in case this is your first video or you've never heard of me, increased consistent deposits is what's going to get you the bag in 2026 and beyond. And I think a lot of people skip over that and not truly understand what I mean by the increased consistent deposits. And here's an example of how I would tell you to leverage this information. Whenever you first go into an institution, even if you have a 800 credit score, we're still not going to apply at that institution because we date the bank before we ask them for anything. Whenever you see an attractive female or you see an attractive male, right? You don't just go up to them and say, "Hey, you want to go on a date?" Right? You kind of work your way into it. You may give them a follow on social media. You may exchange information to show mutual interest to get to that next level, and then you work. The banking sector is no different. So once again, we are dating the bank before we ask for the money. And how we build out with the increased consistent deposits that we're coming in and we're starting off very small. We're starting off with $500 to $1,000, right? That's going to be the average deposit for the first month. Then we're going to scale it from anywhere from 1,000 to 1,500, right? And then we're going to scale it from 1,500 to 2,000 a month. What it looks like is that your business is growing, not you coming in and getting access to a high limit credit card and then you want to deposit $20,000 or $30,000. That's not what we're doing. What we're doing is building out a story. We're making the banks think that we are running a profitable business and we are consistently growing month over month, as we know that's what they like to see. So the source diversity, the timing patterns, all of these things are very important. And one $100,000 deposit does not equate to 10 $10,000 deposits. Now I'm gonna say that again so you don't miss it. One deposit of $100,000 does not get you the same exact internals of 10 $10,000 deposits. So the velocity is going to show operational health. It's going to show cash predictability, revenue stability. Now, what will kill you is random deposits, loan gaps that you go in between there without making a deposit at a specific institution. So what I don't want you to do is make a $10,000 deposit and then wait a few months and then make another $3,000 or $4,000 deposit. We want to try to time our deposits to where it looks as if we are truly leveraging the bank where the deposits are going into. And we're doing this pretty much to position ourselves to ask for the bag at the end of 90 days. So we don't want to have random deposit with long gaps in between there and sudden spikes before applications. We only know when we're going to apply for that credit card if you are running the plays correctly, right? The banker don't know. They don't know what your credit score is. They don't know what your revenue is. They don't know what your income is, right? So you must understand how to play the game. And whenever we understand that, only I know when I'm going to apply for this particular credit card. 30 days before, I'm putting as many deposits as I can into that institution. So if you have a spike in deposits, 30 to 45 days before the time of application, you can still leverage this information to get higher limits. Now, what I won't tell you to do is have a sudden spike of deposits at the beginning and then slow down leading into the application. You want it to always do increased, consistent deposits along the way. And velocity beats balance every time. So, the velocity, how often are you depositing money into this account? That is going to put you in position, right? Now, one of the ways you can do this is you can either do it on a weekly or bi-weekly schedule, consistent ranges with the gradual growth, which goes directly into me saying the increased consistent deposits. If you do this, this is one of the fastest ways to get access to maximum exposure funding in 2026. It is not your credit score. Now, behavior is very important, but don't put all your eggs in one basket. You want to have deposit behavior. You want to have borrowing behavior because it's a difference between borrowing behavior and deposit behavior. Borrowing behavior is going to tell you what type of borrower are you. If you've never had a $50,000 credit card and you go and build out with this institution, even if you were to deposit $50,000 over the course of 30 days, there's still no guarantee that they're going to trust you with the 50,000. So don't disregard the borrowing behavior with deposit behavior. It's a difference between the two. And while we need both, you must understand there's a difference between those two. Now, as we move on, and we have went out, we've structured our accounts, we built up our personal credit profile. Now let's jump into another important topic that a lot of people skip over, which is business credit utilization. And yes, it does matter. We have been accustomed to hearing once you graduate from the personal side and you go to the business side, all the personal debt that you have, we can push that over to the business side, and then your personal credit remains intact and you can continue to go and get access to high limit business credit cards. And that's not all the way true, right? Don't think that you can take personal debt, move it over to the business side, have high utilization on the business credit cards, and think that the business credit banks are not going to pull your business credit from the business credit bureaus. So, what I want everybody to understand is that business credit utilization does matter, despite what you hear. The truth is, it matters internally, even if it doesn't show up on your Experian business. Banks watch how hard you lean on the limits, how long balances stay high. I want to stop right there and I want to really dive deep into pretty much the word I'm looking for is revolving utilization. That's a very important topic that I want everybody to kind of think about and sit with for a second. So, how long balances stay high is very important. If you get access to $100,000 business credit card and you max it out within the first 90 days and then you don't pay it off, let's just say within a 6-month interim, you are actually hurting your internals. So the reason why most people get lower limits on the second card than they did on the first card is because they were not responsible with the first card. I would always instruct you to go out, and anytime that you're going to carry a high balance for an extended amount of time, take anywhere from 3 to 6 months to clear that balance off, right? Make sure you clear that balance off to show that, yes, I'm using the credit, but I'm not relying on this particular credit or I'm not relying on this credit card. Now, another thing that people must understand is like whether balances revolve or reset. That's a very important one. And as we move on to some of the other truth or red flags pertaining to business credit that a lot of people don't understand, pertaining to the revolving utilization, 70 to 90% of utilization for 3 to 6 months, that insinuates that you need the money. So anywhere from 3 to 6 months, I would tell you to go in and clear that balance. Even if you go in, leverage the credit card, you max it out, then you pay the credit card off in full, and then you liquidate the money back off of the card. You have shown the institution, one, a recent high balance, two, that you can manage what's accessible to you. And oftentimes I've had a lot of success with clearing balances on a quarterly basis. So whether the credit limit increase rules are 3 months, 6 months, or even 12 months, you have now shown that you can leverage what's available to you by clearing that balance off. And then guess what? We're then going to go in and ask them for more money in the form of a credit limit increase, because what they see on paper is that Dub Washington has a $100,000 credit card. He maxed it out. He has a $100,000 balance on the card. And now from here, every quarter, he's paying it off in full, but then he runs it back up. In their eyes, they need to lend me more access to money versus you, who may go out and have 70, 90% utilization on these business credit cards. The personal credit is great. The business credit is great. But the revolving utilization, the time frame on that utilization is actually hurting your internal score. Don't just think that the internal scores are directly associated with what you do on a personal side. The business side matters as well. Now, use high utilization strategically, then reset before key reviews, right? Utilization isn't bad, but unmanaged utilization is. Now, you understanding all of this and tying it into how you're going to operate in 2026 and beyond, you must understand we are properly position ourselves for maximum exposure. If a business credit card goes up to 50,000, 75,000, even 100,000, I don't want you celebrating a $15,000 win. Why would you celebrate a $15,000 win if you know the max exposure is, like I say, anywhere from 50 to 100,000? We always want the max exposure unless it requires a UCC one. But anyway, a few other ones that we want to talk about is max exposure and internal scores. Well, a lot of people don't understand whenever I say max exposure is like, this is the ceiling. Every bank has an internal exposure cap, right? Or internal exposure ceiling. This includes their credit cards, lines of credit, loans, sometimes even the total personal exposure. So whenever I say max exposure, how much money this particular institution is willing to lend out to you and be comfortable with it. For some institutions, it may be 50,000. For some institutions, it could be 2 million, right? So understanding this puts you in proper position. And whenever you don't understand it, you wonder why you have the 800 credit score and then you're getting automatic decline. You understand why you're getting limit reductions or no product available at this time for the pre-approval plays. All of these matter, and the internal scores will track total exposure, the velocity of increases, usage behavior, and your deposit relationship. You don't outscore exposure. You sequence around it. So whenever you know that a particular institution may lend off of 10 to 15% of the business's revenue, and then the max exposure on that particular line of credit or business credit card is 100,000, the calculations are there. You just got to calculate it to get the final answer. And once you find the final answer, that's whenever you know what to put on applications, right? And I'm not saying go in and, falsify any information or documentation. What I'm saying is that if you go to an institution that says it's stated income or projected revenue, and they lend off of 10% of the business's revenue, and the actual product that you're going for goes up to 100,000, the answer to the test is right there. Your business is projected, right? Y'all notice I said projected. The business is projected to do a little bit over $1 million this year. Do what you want to do with that information. But too much available credit is a common thing that you will get as you grow and scale along your entrepreneurial journey. This is a real thing. And yes, having too much unused credit can hurt you. That's the reason why I said we're going to go in and we are going to leverage paying off these credit cards after having a revolving utilization period, 3 to 6 months, family. Why do having too much unused credit hurt you? Because banks ask, why does this business need us? That's a very valid question. You have access to all of this credit and you're not using it, and then you get a spike in usage. That's another high risk behavior. Unused credit elsewhere. They're looking at your profile, whether it's on a personal and or business side, and they're seeing what you have access to and how you're managing it. I speak about this a lot whenever we are auditing credit reports. Most people are going to look at what's the limits that you have. One of the first things that I look at and can tell you more about you than any other payment history, the utilization, so on and so forth, is like, what is the recent high balance on these credit cards and what is the current balance? Very important. because recent high balance shows that you possibly maxed a credit card out, which is a great lagging indicator or which is a great look back period. But then whenever you get to the actual balance that is there, if it's zeroed out or very low and you had a recent high balance, you have just shown multiple credit card issuers or multiple lenders that you can leverage the credit that's available to you. It's really a game inside of a game that we must understand. And it's literally like a switch that we have to start looking at credit differently. Stop looking at credit as availability of something. Look at credit as access to something that you've never experienced before. Because if you use it the right way, you can access a completely different life, all from something that is literally made up, right? Now, credit is meant to circulate, not sit. That's why I talk about we must use the credit. Whenever you get to, I would say about 250,000 or 300,000 on the personal side, and you're having consistent months go with 0% utilization, listen, you've done nothing wrong. You have nothing to spend it on, and you're not going to put yourself in unnecessary debt by purchasing liabilities. But if you have an extended time frame to where you're not using any credit, it's always at 0% utilization. Do you need the credit? And in today's economy, banks are shutting credit cards down, they're lowering limits. So you must understand that you must use it or lose it. It's your decision. Now, as we get into the relationship banking and inquiry sensitive banks, you must understand this in totality across everything that I said today. Relationship banks look at deposit tenure. They look at the product depth. How many products do you have with us? Engagement history. How long have you been with us? Were we allowed to grow with you? And whenever you understand the importance of all of this, you're able to sequence your deposits. You're able to sequence your next funding rounds because credit is a game of strategy. And if you have the correct strategy, you can beat anything that you're going against. You just got to have the correct mindset, the correct strategy, and know what you're doing. So, this is why order matters. You don't apply everywhere, you apply intentionally. I understand that, this bank is double dip. I can go in and get access to multiple products and I only pull my credit one time. I understand that this institution specializes in business lines of credit. So I know that I need to go out and build a strong deposit relationship. I need to have, some recent high balances report on my business credit. If they do report line of credit usage on the business credit bureaus. So if you understand what the bank specializes in or what the institution specializes in, you know kind of like what to ramp up in certain seasons and what to tone down in certain seasons. Is a spike in usage good at certain institutions? That's a double-edged sword. To some, yes. To others, no. Right? And you understanding which institutions like to see what activity, all you're doing, family, is positioning yourself to get access to the max exposure in 2026. So once again, we're not applying randomly. We're not applying everywhere. We are sequencing our funding rounds. We're knowing ahead of time, particularly each quarter, you should sit down and develop your next funding sequence. 3 to 5 banks every 90 days keeps poverty away. 3 to 5 institutions every 90 days will keep poverty away. You will never have any more money issues. It's not that you don't have the money, it's that you don't have access to liquidity. You don't have access to the credit. Because if you get access to the credit, you can make or generate the income and revenue that you need, all because you have access to this tool. Think about how much easier it would be if you had the perfect tool for the perfect job. Videographers, if you had the correct camera and the correct lens and the correct audio, everything is easier for you. Entrepreneurs, if you have the correct coach, you have access to credit, and you have the right mindset, everything is available to you. For my contractors or people that, that's working with their hands, if you have the right tools in the right toolbox with the right screws, your job is going to be that much easier. So that's what credit should be framed around, is having the correct tools and understanding how to use the tools, because you can have the best camera equipment, you can have the best lenses, the best audio, the best lighting, or you can have all of these things in place. And what happens is you don't know how to properly leverage it. I can't tell you how many times I've seen people have direct access to information, but they're not the right person to leverage that particular set of skill sets or the information available to them. So everything that I'm talking about today, family, is to literally put you in position. Now, I can't help you with becoming the right person with your mindset. There's many coaches online for that. I'm the person that's going to put you in position whenever you're ready to access the capital. Because if you implement these strategies and look at credit and look at banking the way that I teach you, you're going to go into the banks a completely different person. They're going to give you more respect, and they're going to give you higher limits, assuming that your profile is where it needs to be. So whenever we get to the revolving utilization, carrying balances the right way. Now, like I said, carrying balances isn't bad. Carrying them without a plan is. Now, the banks track the balance aging. And it's a lot, like I told you, we're going to really dive deep into this masterclass today. Like the balance aging, once again, also known as the revolving utilization, you don't want to have 70 to 90% utilization for 6 to 9 months. That is way too long. You look risky. It is a lot of that going on in 2026. Your pay down behavior. How frequently are you clearing the balances? I can't stress the importance of that because some people get access to credit and then they get their first 100,000, 200,000, and then for the next 2 years, they're making minimum payments. Deposit behavior, payment trends, revolving utilization. All of this matters because you don't think that the bank is tracking it, but with AI coming into place in the banking sector, all of these things are being tracked and they are predicting your next move down to the T. These algorithms understand you better than yourself. And the number one job of a underwriter is to mitigate risk. If you look risky during this particular season, we can't lend you any money. Now, let me tell you this. If you have a extended 0% APR phase and then you are carrying a high balance, so let's just say 90% revolving utilization, that's more understandable than you having 90% utilization and you're paying interest on the balance that you're carrying. That is financial suicide. So, promotional APRs, predictable payments, all of these things makes you look a lot better on paper. And once you understand how to leverage it, family, I can assure you, this is whenever you start getting access to higher limits. Now, I spoke about this before, and it's authorized users. And I know a lot of people gave us pushback on the channel about why authorized users do work whenever I said that they did not work. And I need to add more context beyond that. I didn't mean that they literally do not work. Now, they work for adding age to your profile. They do not work for getting you access to higher limits. Because one thing that I can tell you about authorized users is that the payments is very key. If you get added onto someone's credit card as an authorized user and you never use the credit card, what are you allowing the bank to see about you? Your goal should be to be added to build internals, not be added to build out a higher credit score or to increase your age, even though that is a result of being added as an authorized user. But we don't think that way on this channel. We're thinking about internals. We're thinking about the exposure. We're looking at credit from a completely different lens. So whenever you walk in to apply for your primary, you get access to the highest limits. So with all of that being said, family, strategic carrying is understood with a promotional APR, unpredictable payments, and planned exit. All of these things makes it look like, even if you don't understand the credit system, because whenever you have high utilization on a business credit card that was open 6 months ago and you going in and you're talking to your relationship manager, they may ask you, why are you carrying such a high balance? You explaining that it is during a promotional APR, a 0% APR strategy, and you have that money working for you, that makes you look more smart, even if that's not what you're doing. Now, on this channel, we're taking that 0% APR and we're building other banking relationships. How I would answer, just to be honest with you, is I would simply say the money that you see in the revolving utilization more than likely is the amount that I have sitting in your account. So if they have a utilization issue, then I can just liquidate the money or I can just pay off the credit card with the checking account balance that I have at your institution. So once again, before we go for funding at the new institutions, at least have a substantial amount, at minimum $10,000 at the time of application, because this gets you that low 5 of an internal score. So whenever you go in and you have a high balance on the credit card, most people with a consumer mindset, they say, what does the minimum do? What's the minimum amount due to keep the credit account active? And it's typically going to be, let's just say 10 to 15% of your overall limit. As we spoke about authorized users, and I got a lot of pushback on that, a lot of people don't understand the inner workings of it. If you're being added as an authorized user on someone else's credit card, you must understand that the banks want to see your behavior. They don't want to see the primary in your account. They want to see your behavior, not borrow optics. They don't want to see that you have the AU on the account, it's a high limit, 0% utilization, all of the things that people are selling you. Now, imagine being added as an authorized user. You've been on there for a year. You walk into that institution. And the moment you walk into that institution, you sit down and apply and say, hey, I've been a customer with you guys for the past year on a authorized user that my wife added me to. It was for $20,000. And they said, okay, well, they have some borrowing behavior on you, but when they go to look at that account, guess what happens? They don't know where you like to spend money at. They don't know how much money they made off of you. So they don't have any metrics to lend to you off of. So don't be surprised if you get started with a low limit, even though you are added as an AU for the past year, because they want to see the payment trends. Now, as we go from authorized users to the quality of accounts, this is the silent killer, because everybody that you may see on YouTube, Instagram, TikTok, all of these social media platforms, they're pushing you to credit builders. And let me say something real quick. Whenever they're pushing you to credit builder accounts, understand that they have an affiliate link behind the credit builder accounts, because it's not that they're truly trying to help you. And I'm not speaking about all people. I'm going to get a lot of pushback from this, but you must understand how influencer marketing works. I develop a large brand and I get hundreds of thousands of followers, and I can literally say, hey, go and add Kovo, go and add Best Egg, go and add any of these credit builder accounts to your profile. I sign up with them to get an affiliate link. And for every person that I get signed up under me, I get a $20 payout each month that they have this account on their profile. If I go and get 1,000 people to sign up for this credit builder account, guess what happens? I have now generated $20,000 and I haven't helped you any. I'm going to get a lot of pushback for that, but I'm just letting you know from the other spectrum, from the other lens, on the other side of the field, that you do not see in this particular arena of influencer marketing. So be mindful whenever people are telling you to do things that they have not done themselves. I tell you everything that I've done step by step, and adding credit builders was not one of those. Now, back to regular schedule programming. Quality of accounts is very important. Tier 1 banks are going to get you access to way more credit than the subprime lenders. Revolving products are better than credit builders. Do not think that the banks are not monitoring your behavior. And it's not even an underwriter. They have artificial intelligence literally tracking every deposit, every spending category that you're in, and they are lending to you based on what they think about you. And store cards, this is only valuable to the stores that you can spend the money at. Understand, family, like, we're operating differently in 2026. The next thing that I want to discuss, someone had a good question that they asked me, is like, Dub, how do you leverage a promotional APR? I need a true strategy. And I wanted to break it down so everyone understand it. Right. So whenever you go out and get access to the 0% APR capital, it is not to invest right away. You can take the first 90 days from each business credit card that you get to go and build another banking relationship that is going to extend to you the exact promotional APR phase that you got with the first product. So if you go out and get access to 20,000, 0% interest for 12 months, you take the first 3 months of this promo APR phase, and you build with another institution that has business credit cards that's going to give you access to 0% APR financing for 12 months. 3 months has now bought me 12 months. I hope this makes sense to everybody. So guess what I'm going to do? 3 months bought me access to 12 months. I then take the money from the institution that I deposited in, leave the minimum balance there required to avoid any service fees, so on and so forth. And from there, I'm going to take that same exact money and go to another institution and leverage this next 3 months for another 12 months APR phase. So all I'm doing is buying 3 months to get me access to 12 months. You will never have any funding problems if you continue to follow this strategy and have a structure card. Have a strategy whenever you get access to this promo APR phases to put you in position. Now, with all of this being said, family, this was an in-depth Q&A about some of the topics that I've discussed on other videos. And any questions, any topic, any strategies that you want to see on the channel, I encourage you to engage in the comments. I have someone that is monitoring these comments, and every question, every concern pertaining to business, pertaining to finances, strategy, sequencing, all of these things, and I'm here to serve you. But if you want to take it a step further, I have a lifetime mentorship that you can join. All links will be in the description. And I have a $99 school group, and we are consistently growing. We sharing wins with one another. I'm developing a community that no one has ever seen before. And it's not that it's better than any other community, because it's a lot of people providing value, but my community is going to be thought-provoking leaders. We're going to be leaders in the form of finance to where we apply pressure to the bankers, right? Because one of my goals, as we all know, is to make the banks compete to lend you money. If you don't understand the inner workings of the bank, how can they compete to lend you money? They're going to treat you like every other regular Joe that walks in there. But whenever we walk in with confidence, when we walk in with knowledge, and we are interviewing the banker, this is what's going to separate us apart from everybody else. So once again, family, I encourage you to drop any questions, comments, concerns in the comments. Let me know what you want to know on this channel. Let me know what topics you want me to bring to you. And as always, family, I appreciate you. And in my words, everybody eats. I'll see you. Let's go.